In 2026, a financial tidal wave is set to crash into the Canadian housing market. For about 60% of homeowners renewing their mortgage in 2025 and 2026, this means their payments could suddenly jump. We are talking of increase of 15 to 20% for many, which could mean an extra $500 vanishing from your bank account every single month. For many, this will be a financial nightmare, but for a selective few who see it coming, it will be a wealth building opportunity of a lifetime. In this video, I am going to show you exactly which group you'll be in. Homeowners, it's time for a reality check. That fixed mortgage payment isn't as permanent as you think. According to the Bank of Canada, a massive wave of mortgages are up for renewal in 2026. The majority of these are 5-year fixed rate mortgages signed back in year 2021, when interest rates were at historic rock bottom lows, even as low as 2%. Fast forward to today, that economic landscape has completely changed. The era of ultra low rates is over. When these mortgages came up for renewal, homeowners won't be looking at 1.9%. They'll be staring down the new rates significantly higher than what they locked in. What does that actually mean for your wallet? Let's put it in real numbers. Imagine a homeowner with a $500,000 mortgage balance and 20 years left, who locked in at a comfortable rate of 2.5%. Their monthly payments have been manageable at $2,650, but with the renewal rate of 4.5%, that payment explodes to $3,150 a month. That's an increase of $500 every single month, or $6,000 a year. That's a 20% hike overnight. This isn't a scary story. Bank of Canada confirms it, showing that homeowners with a 5-year fixed rate renewing through 2026 are facing average payment increases of 15 to 20%. This isn't a maybe. This is the reality for hundreds and thousands of Canadians. And while some with variable rates mortgages might see some relief, others could be facing payment increases of over 40%. It's a shockwave building just beneath the surface of our economy. Let's make this even more real. Meet the family Smiths. They're a typical Canadian family. In 2021, they bought their dream home with a great 5-year fixed rate and have been comfortably making their payments. They have budgeted for groceries, car payments, even a small vacation fund. But what they haven't budgeted is for those mortgage rates suddenly increasing an extra $500 a month in 2026. That's extra $6,000 a year. It's the money that they were putting into their kids' education fund. It's the saving that they were building for their retirement. It's the financial breathing room that kept them from living paycheck to paycheck. Now it's all gone, eaten up by the higher mortgage payments that they never saw coming. And the Smiths are not alone. There are over 1 million households just like them, all set to renew their mortgages around the same time this year. This concentration of renewals create what Canada Banking Regulators OSFI has identified as a top risk for the financial system, a collective payment shock that will squeeze household budgets right across the country, forcing families to make incredible difficult choices. This isn't about mortgages. Home and auto insurance premiums are also climbing, adding another layer of financial pressure. Suddenly, families like the Smiths find their financial stability crumbling. They start dipping into their savings or racking up their credit cards just to cover the new monthly shortfalls. And the dream of home ownership quickly turns into a financial prison. This is the silent crisis brewing in the neighborhoods all across Canada. But what if the shock wasn't a crisis, but an opportunity? What if the same forces squeezing the unprepared could be used to your advantage? For every homeowner caught off guard, there's another one who was prepared. While some will be forced to cut back, sell their home, or dip into the high interest rate cards, others will use this exact moment to pull ahead. The difference between the two isn't luck, it is strategy. This payment shock is a predictable event. The numbers are out there, the warnings have been issued. The next few minutes aren't about scaring you, they are about arming you. I am going to lay out the two-part strategy. Your first priority is to build a defense so strong that payment shock glances just right off you. This is about protecting your cash flow and securing your home. Here are 3 critical defensive moves. Don't wait for your lender to send you a renewal slip a month before it's due. They're counting on your complacency to lock into the uncompetitive rates they give you. You need to start shopping around at least 120 days before. That's 4 months before your renewal date. A mortgage broker can help you secure a rate hold which locks in today's best rates. If the rates go up, your renewal, you're protected. If they go down, you can often grab the lowest rate. It's a free insurance policy against the rising rates. One of the most powerful new tools for homeowners is a rule that changed from OSFI that took effect in late 2024. If you have an uninsured mortgage, you can now switch to a new lender at the new renewal without having to pass the grueling mortgage stress test, as long as you are not increasing your loan amount. This is a game changer. It eliminates a huge barrier that used to trap people with their existing lender. Now, you have the power to truly shop the market and force lenders to compete for your business, potentially saving you thousands of dollars. If you are facing a big payment jump, one of the best ways to soften the blow is to extend your amortization period. The government recently expanded eligibility for 30-year amortization for first-time buyers and those purchasing a new build. For others, even stretching a remaining 20-year loan back out to 25 years can dramatically lower your monthly payments and preserve your cash flow. Sure, you will pay more interest in the long run, but this move is about immediate financial survival. You can always make aggressive lump sum payments later on to get back on track. Now that your defense is solid, it's time to go on the offense. This is where you transform your mortgage from a source of debt into a powerful financial tool. The number one offensive strategy is debt consolidation refinancing. Many Canadians are being crushed not just by their mortgage, but by high interest rate consumer debt. Credit cards often carry interest rates of 20% to 30%. A car loan could be sitting at 8%. This is what I call bleeding cash. You are just throwing away money on interest payments every single month. If you have equity in your home, you can perform a strategic refinancing. This means rolling all of your high interest debt, credit cards, line of credit, car loans into your new low rate mortgage. Instead of paying 20%, 30% on credit card balances, you are now paying the much lower mortgage rate of, let's say, 4.5%. The impact on your monthly cash flow is massive. This is one move that can free hundreds, even thousands of dollars per month, stopping the financial bleeding and immediately improving your financial health. This is not about borrowing for a vacation. It's about restructuring your debt to accelerate your wealth. Your second offensive strategy is to leverage your equity wisely. Your home equity is a powerful asset, but not only if you use it correctly. The key is to avoid the biggest wealth-destroying traps, maxing out credit cards and buying unaffordable cars. These are depreciating assets financed with high-cost debt. Instead, think like an investor. The cash flow you freed up from the debt consolidation can now be redirected. You can build up your emergency fund, start making lump sum payments on your mortgage to pay it off faster. By using your mortgage, the cheapest debt you can get, to eliminate expensive debt. You turn your liability into a tool that builds your net worth. Have you seen your home insurance or property tax go up recently? Let me know in the comments below what's putting the biggest squeeze on your budget. The 2026 mortgage payment shock isn't a possibility. It's here. A financial tidal wave is coming that will catch millions of unprepared homeowners by surprise. But you won't be one of them. You now know the problem. A massive wave of mortgage renewals is at significantly higher interest rates. But more importantly, you have the solution. You have the defensive strategy, acting early, using the straight switch, and adjusting your amortization to protect yourself from the initial shock and to have the offensive strategy, consolidate debt, and leveraging your home equity wisely. You're no longer at the mercy of the market. You are in control. You have the knowledge to not only survive the coming shock, but to thrive because of it. If you found this information helpful, please subscribe and hit the notification bell for more content on the economy and real estate. And if you are thinking of buying or selling, please give me a call directly. My information is attached below. Until next time, see you soon.